Hi students, this is Suchadata teaching economics to class 12 and here I am with your 8th unit and the name of the unit is National Income Accounting. Well, when we talk of income, the income is of a household, income is of a city, income is of a state and of course the income is of a country. When you have to calculate the national income, you have to keep in mind the three pillars on which this national income is calculated. And those are the income that you have is to be calculated, as I said, on three factors. And when these three factors are to be calculated, they are the consumption, the expenditure, and of course, the third one, what we say, the production. Which means that since the dawn of civilization, since the beginning of civilization, the humankind had three main activities of producing, of consuming and of spending. Spending in terms of whatever currency was available at that point of time. Well, that means when we calculate all these three under one head, that is the production, consumption and expenditure, it gives us what we call as the national income of a country. Deleting or not calculating either of them will not give us the true picture of the national income of a country. But when we talk of it in a broader sense and ask ourselves as to what is national income, then national income is in fact the money value of all the final goods and services of a country, including the factor income. So once again, what we are seeing is that all the goods and services which have reached the final stage are calculated in the national income. And there are various kinds of goods and services which we must understand before we understand the term final goods and services. Now, what are final goods? Final goods are those goods which are required by the consumer as final consumption, including the investments which are done by the firms. Now, when I talk of it in an individual sense, it means that whatever I buy directly, I consume it, is the final good. And of course, the firms, whatever is their investment, stands as the final good. Now, what is an intermediate good? An intermediate good is the good which is in fact a raw material which they have purchased from another firm or which they will be using as reselling in the same year. When we talk of it in an easier term, we will calculate it this way. Supposing here cloth is bought by the firm. Now this cloth, if you see, if it is used directly by the consumer, it can become a final good. But when this cloth is made into a shirt, then it becomes a final good as a shirt and not as a cloth. Which means when I have to calculate this national income of a country, I cannot be calculating it twice as a shirt and as a cloth. If I do this, there will be the problem of double counting, because I am calculating the value of the same cloth and of the shirt which is made from the same cloth. So that is why we stress on the point that the final goods and services are to be calculated in the national income of a country. Well, when we talk of the final expenditure and the intermediate expenditure, the same stands as when there is purchase of goods and services by a firm as final, that is the final expenditure. Whatever it buys and uses it as it is called as the final expenditure. It could be the machinery, it could be the building, but when the expenditure is done on the items which have to be processed, which have to be used further to make it into the final shape, that is an intermediate expenditure. Now, in all these terms, the simple thing which you have to understand is that the final shape when it is taken of any commodity, of anything, that actually is the final good, and intermediate goods cannot be calculated in the national income. In this, there is another term which you must know is the resident of the country or the normal citizens of the country. They are the ones who have their economic interest in the country, who've been staying in the country for quite some time and who have their economic interest, I said, in the country. But this is not to be applied, the normal citizens, the normal residents, to those who are either patients, students, because though they have been staying there, but their economic interest does not lie in that country. So, the activities, if we say, of the normal residents, that is those who have their economic interest in their country, and that too on three pivots, that is the production, consumption and expenditure, gives me the national income, because with the production of anything comes the income, and with this income, as I said, then comes the money which gives me the power to buy it, that is expenditure done by an individual. Of all the activities that you will analyze about yourself, you will understand that they are moving around these three only, that is production, consumption and expenditure. In the national income accounting, other terms which you must know before you can calculate the national income are consumption goods. The word as it is suggesting is the good which are used as final consumption. And I have already given you the example in the previous clipping how an intermediate good becomes a final good, and that final good we have taken it as the shape of a consumption good. That is the good which is ready for consumption for the consumer is the consumption good. It could be the shirt or a cigarette or whatever, we can use it as ready consumption. Then we have the capital goods. Capital goods are those goods which are meant for generating income. That is, they themselves are as such not meant for final consumption, but they are the ones which make commodities, things which are meant for final consumption. It could be the machinery of a firm. So, this means that this machinery is going to produce the final consumption good shirt. Though this capital good in itself cannot be used as a consumption good. Well, when I talk of the capital goods, they have certain characteristics, like they are in fact the most important part in the consumption and in the production area. Besides, this capital goods tend to depreciate. That is, wear and tear of the goods is an essential part of the capital goods. Not only this, they also have the tendency to become obsolete. With the coming in of new machineries, with the coming in of new technologies, the machinery owned by a firm tends to become obsolete. So, this capital good is in fact the good which has the characteristics of depreciating and also becoming obsolete. So, all this is to be kept in mind while we are calculating the national income of a country. Then capital formation, that is making of a capital, forming a capital. This is in fact the excess production which is done over consumption and which is kept as a stock, which is kept for further use in future, is in fact the capital formation. Then we talk of the flow variables and the stock variables. The flow variables are those variables which are measured over a period of time. Say 1966, 1999, that is, it is measured over a period of time. And if I have to give you an example of a flow variable, the best example could be of a national income. The national income of India, say in 1991, was this much. So, we are measuring this variable over a period of time. But when I talk of the stock variable is that variable which is calculated at a point of time. That is, as the name is suggesting, it is a stock at a particular time. On 26th January 1950. So, at a point of time when the calculation is done, when it is measured, it is the stock variable. The examples can be of the loan that you have taken or even of a population that is at a particular point of time. These are the various new terms which you need to understand of the consumption goods, capital good, and also the capital formation and the flow variables and the stock variables.